Time plays a significant role in the performance of investments in the stock market, share market, and mutual funds. Let me explain how time affects each of them in simple terms. 1. Stock market and share market. The stock market and share market are essentially the same, so let's talk about them together. How time affects stock-share market. Short term, 1 to 3 years. Stock prices can be unpredictable in the short term. The market goes up and down due to news, events, or market sentiment. Example, if a company has a bad quarter or there is negative news, its stock might fall in the short term. Medium term, 3 to 5 years. Stocks tend to recover from short-term declines. However, it's still affected by market cycles, like bull markets or bear markets. Over time, the growth potential of good companies becomes clearer. Long-term, 10+ years. Over long periods, the stock market tends to grow due to the fundamental growth of companies. Companies like Reliance or Infosys have shown consistent growth in the long term. Compounding plays a big role. As companies grow and become more profitable, the value of their stock increases, benefiting long-term investors. Key idea. In the short term, stock prices can fluctuate a lot, but over long periods, good stocks tend to give good returns due to company growth and market recovery. 2. Mutual funds. How time affects mutual funds. Short term, 1 to 3 years. Mutual funds can still experience ups and downs because they invest in stocks or bonds, which may not perform well in the short term. You might not see huge gains, and your investment might even lose value if markets fall. Example, if you invest in a stock-based mutual fund and the market crashes, like in 2020 due to COVID-19, you could lose some of your money in the short term. Medium term, 3 to 5 years. Over 3 to 5 years, mutual funds typically perform better because they spread the risk by investing in multiple stocks or bonds. The diversification reduces the risk of big losses. Example, a balanced mutual fund, stocks plus bonds, could give moderate returns over this period, even if some individual stocks underperform. Long-term, 10+ years. The longer you stay invested, the better the potential returns because mutual funds benefit from compounding. They typically generate better returns over time, especially equity-based funds, stocks. Example, if you invest in a growth-oriented mutual fund for 10 years, you are likely to see significant returns as the fund grows with the market. Key idea. Mutual funds are generally less risky than individual stocks, and their performance improves over time due to diversification and compounding. Time and its impact on risk. Short-term investments, less than 1 year, tend to be riskier because markets can be volatile. There might be big price fluctuations in the short term. Long-term investments, 5+ years, tend to smooth out market volatility and give your money more time to grow. Real-world example. Let's say you invest in the Nifty 50 index, which includes top companies like Reliance, Infosys, and HDFC Bank. Here's how time affects the return. 1 year. You might earn +10% or -5% depending on market conditions. 5 years. You may earn +50% if the market has grown, but this still depends on the overall economic cycle. 10 years. Historically, the Nifty 50 has given an average return of 12 to 15% per year over the long term, which is compounded, so your returns grow much larger than the short-term ones. Conclusion. In the short term, the stock market and mutual funds can be volatile and may give unpredictable returns. In the long term, these investments tend to grow steadily, benefiting from compounding and market recovery. The longer you invest, the more likely you are to see good returns. Mutual funds are generally safer for long-term investment because they diversify your risk across different assets, while stocks can be more volatile but have high growth potential.